Welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Seema, Mody, in today for Bob Pisani. And I'm joined by Jay Jacobs, Head of Research and Strategy at Global X Funds, Jeff Kilburg, CEO of KKM Financial. Stocks hitting the pause button on their record run today, but a big November rally in bond yields could spark the next leg higher. Money has continued to flow into bond funds all year, despite meager yields up 15% compared to flattish flows in U.S. equities. But the spike in yields has some wondering if a great rotation is in the cards. And Jay, could the moves we've been seeing in the bond market be enough to pull money out of bonds and back into stocks?
I think absolutely, at least in the short term. I mean, this has been a fantastic year for long-dated bonds, more than anyone expected, I think. Yeah. And so people are starting to take those profits and move them into equities, where we're starting to see kind of a warming equity market. I think the caution here is some of the equities that are more bond-like utilities, are very expensive. So people should probably look at kind of the lower valuation, kind of cheaper yielding stocks like in financials, where there's better valuations, as a bond replacement.
Yeah, it's an interesting point, because at the same time, Jeff, some analysts at Bank of America say this rotation into growth, into value, makes sense at this point.
It does make sense. I think a lot of people are talking at this moment in time in Q4. We're confident that we're going to get some type of phase one trade deal, but it'll be interesting to see if we can actually have a rotation or simply book profits. We see a lot of registered investment advisors out there, active investors trying to book those profits and find those sectors to rotate into. So last week was interesting. We saw financials really get a jump. We saw industrials really get a jump. But it's interesting about the bond market. I see a cap in the 2% yield in the 10-year note. And a lot of people, if you would have said it was 2019 and that we were still going to be under 2%, you would have laughed at us. So just a year ago, Seema, I think we were sitting here talking about where these bond yields are going, but TLT still is revealing relative strength. We run a lot of ETF model portfolios based upon relative strength, and that strength, yes, there has been profit taking, Jay, when we bounced off that yield down at 150 in the 10-year, but right now it's still exuding some type of strength going into the end of the year.
Are there any bond proxies, Jay, that look attractive to you, especially if the 10-year continues to trade at where it is right now?
Yeah, so we like the preferred space. What you're looking at in the preferred stock market is very high quality US-based financials firms, but they are very well capitalized and they're kind of higher yielding than traditional investment grade bonds. So usually you're seeing 6 or 7% yield with still much better valuations in our opinion than the investment grade bond market.
What is the bond market telling you, Jeff, about what the Fed could do next?
Well, that's the thing that's the biggest takeaway from 2019, because last December, Seema, we saw a very hawkish Fed talking about 3 rate hikes, and all of a sudden a 180 flip, and now we have 3 rate cuts.
How quickly it changes, right?
How quickly it changes, but that accommodative stance, no matter what your view is on the bond market, that has really been relevant. This is the most stimulus we've seen in the system globally, the ECB, Bank of Japan. This is the most money we've seen in the system in 10 years. So I think that money has to work its way through. Therefore, when you look at the 10-year note, being under 2%, still in comparison to some of the other foreign sovereign percentages like the German bund, I still think it's still attractive. If we do get to 2%, I think you see that rebalance come back in and buy those treasuries. So the bond phenomena of 2019, I don't think it's over yet.
That's a great point. I mean, on that note, given that the central bank easing has really been a global story, would you prefer U.S. financials, Jay, over their peers in Europe, let's say?
Oh, absolutely. I mean, the U.S. financial system is just so much better capitalized right now and such better strength. It's really a play on the U.S. consumer. We've seen a lot of good expansion of credit, a lot of opening of new bank accounts, things that are a positive for these banks in the U.S., and you just don't see any of that in Europe right now.
The idea, Jeff, that we get back to 3% on the 10-year, does that ever happen?
I think it's a little far-fetched, but I think we'll see it in our lifetime, Seema. But in all seriousness, yes, I think once the Fed really sees what all this money, this flooding of money, they've been involved in the repo market, there's just a lot of pieces of the puzzle we have to see, and I don't think we really are able to understand that or digest that until Q1 2020, maybe even Q2. But right now, it is propelling U.S. equities. We are seeing a small rotation in international equities, because that's been the reversion. Do we see a mean reversion? Do we see international equities catch up to U.S. equities? Potentially, but right now, this has been the best game in town.
Yeah, because year to date, Europe is underperforming the U.S., but in the last 1 month, we've actually seen a pretty strong rebound, not just in Europe, but in China as well, Jay.
Yeah, it all has to do with sentiment. I mean, going into the beginning of this year, people were so bearish on Europe, so bearish on China, and it's just not as bad as people expected. So you've seen substantial returns in certain areas in China, like the consumer discretionary sector. You've seen very good returns in Germany, and it's purely just, it's not as bad as we thought.
How much do you think this trade phase one deal is being factored into today's move today?
I think it's a little bit less than I would have anticipated because of all the unrest in Hong Kong. We saw what happened over the weekend. I thought the market could have been down a lot more. So I'm pretty constructive on the market going into this weekend. That's where they're going to be in Chile, hopefully signing some type of agreement. We just want to see some ink on paper, Seema. At the end of the day, that's going to bolster the market and move us higher. I know we're at all-time highs. It seems like every week. We've had 5 weeks in a row in the S&P 500 continue to go higher. But it's all about this weekend because that has been the front.
Well, that summit was canceled, but I guess the big question is where else would they sign that deal since Chile summit is not happening. Let's actually shift gears. Single biggest online shopping day of the year is happening in China. Alibaba's Singles Day, topping at $38 billion in sales and setting a new record, though at a slower pace than a year ago. Despite a broader economic slowdown in China, the Chinese consumer still appears to be faring remarkably well. Kevin Carter joined us, and he is the founder of EMQQ, which is coming up on its 5th anniversary. Kevin, tell us about the idea of EMQQ and how Singles Day plays into it.
Well, the idea of EMQQ is that 85% of the world population lives in emerging markets, and those economies are growing faster than ours. And what's emerging are the people, the consumers. And that's the story. And just as consumption has changed here with the smartphone, it's changing in the developing world, in China, in India, in Africa, but it's changing and leapfrogging what we think of traditional consumption, and this giant part of the world's population are becoming consumers with a supercomputer in their pocket as so-called digital natives, and it's a big deal. I
imagine the biggest threat to this trade, to this sector, is the ongoing trade dispute and also the softening in China's economy.
Well, China's economy has been softening in terms of GDP growth slowing for 15 years. The consumer growth remains quite strong, but to the points that were made earlier, sentiment has been the problem. The fundamentals of this story have been incredibly sound. I think it's the fastest growing sector in the world in terms of revenue. But we had large declines coming into this year, about 30% last year, but the fundamentals were great. And so it really has been about sentiment. And I actually take comfort in the fact that we have a pretty significant trade war. We have literally blood in the streets of Hong Kong. And now, at least in the last several weeks, even LeBron James has been dragged into the conflict. So I think that it's hard to make up a scenario where the backdrop would be even worse than this. So I take comfort in the fact that we're not down that much today, and in fact we're up over 20% for the year.
What are some of the major holdings in the EMQQ, and how did you select these constituents?
Well, it's index-based, so we own every emerging markets internet company that's publicly traded, as long as it meets certain market cap.
So Alibaba, JD.com.
Alibaba, JD, Tencent, PDD, but also it's not just China. This phenomenon is spreading. It's spreading to India, to Africa, so we own Mercado Libre, which dominates from Mexico to the tip of South America. We own Jumia, which went public here at the NYSE earlier this year, which is the African leader in e-commerce. So it's the same thing that's happening in our world, the smartphone consumption, but most of the world never had bank accounts. They never had traditional retail stores to go to. So the growth rates are, the revenue growth rate remains about 30% for the sector.
If I could put one more thing in here, Seema, with the win in the sales of your ETF or any emerging ETF right now, it is the conversation with the Federal Reserve, the ECB. All this global money is being injected to the system. So right now it's interesting, as long as the US dollar stays stagnant into sideways, that's going to help all the emerging markets. And when you talk about 2019, there's just been a ton of noise. But if you can understand where the dollar is going, which essentially has been nowhere, that has been the real barometer, and I think that helps emerging markets in 2020.
You bring up an interesting debate because there is that strong consumer story that is certainly playing out in emerging markets, Jay, but at the same time, macro factors like a stronger dollar has really derailed the EM rally.
Yeah, but in emerging markets, it's a little bit different because you look at something like China, which makes up about 40% of the emerging markets, and their impact is even broader than that. And it's such a top-down effort from that government to push consumerism, to push e-commerce, to get cell phones in people's hands. This is not just kind of standard economic
organic growth.
Yeah, this is the government saying we want people to buy stuff online right now.
Interesting. Are you a buyer of any of these names that are in the EMQQ?
We hold a lot of similar names in our China Consumer Discretionary Fund, and we're swimming in a similar direction. There's a real shift within China, within the emerging markets, to push consumerism rather than just being an export-led economy.
And Kevin, have you been widening your search as more companies diversify their supply chain outside of China into to other frontier markets like Vietnam and even India?
Well, the supply chain element, the supply chain elements are relevant to the handset makers, and the handset makers are certainly part of the EMQQ story, but they're not holdings. We own just the internet companies, and so we don't care if they're on a Xiaomi phone or a Huawei phone. What we care is that they're accessing Alibaba, they're accessing Mercado Libre or PDD, and I think what was just said is accurate. This is a secular trend. This is a one-directional thing. But we've had computers for a long time. We've had the internet for a long time. 85% of the world's people are becoming consumers. They never had a computer. They never will have a computer the way we think of them. The smartphone will be the first and only computer for most of the world. And they're getting internet access as well. So it's a sort of a turbocharged growth story as these wave of consumers leapfrogs, uses the phone for their wallet. They skip the traditional bank system. And I think, as said, this isn't the traditional emerging market cycle. This is a combination of three mega trends all happening at the same time, which is driving this growth. Yeah.
Any of these names have access to the U.S. consumer?
Minimal. I mean, I had a birthday party this weekend and someone gave me a Shanghai Sharks jersey, which was bought on Alibaba. So there's
happy birthday.
Thank you. So yes, people in America do buy things on Alibaba or otherwise, but it's really quite a very small piece of the revenue chart.
Good stuff. Thanks for bringing your perspective today, Kevin. That does it for us and this week's ETF Edge. I'm Seema Mody. My thanks to Jay, Jeff, and Kevin for joining us today. And thank you for watching. You can find all our latest videos right here on our website, etfedge.cnbc.com. We will see you next Monday, same time, same place. Have a good week.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.